So November 2016, question 5. And this November 2016, question number 5 is on cost bookkeeping. It's on cost bookkeeping. So we are told to do the income statements. So we have details. We will have costing books and finance. So when you prepare it like that, we begin. And we have direct materials confused. You can have our figures in thousands. Direct materials. So direct materials, that is a figure that arrives both in finance and in cost. So you record it here, 50 and 250. Oh, sorry. For additional information, so we are told in additional information number 1 that in cost accounting, materials were 280. This is 280 there. That's 280 there. Direct wages. So direct wages is not mentioned in the additional information. So you bring 100 here and 100 there. When you do that, you get a figure called prime costs. You get a figure called prime costs. This is 350 and this is 280.
380.
Sorry, that is 380. you bring factory overheads. Factory overheads. Factory overheads is in finance, it is 380. But in cost, you can see, according to information 2 here, they are recovered at 20% of current cost. So this will be 0.2 times 380. 76. But in finance, we are given 380. Finance, we are given 380. When you do that, you get a figure called production costs. Add these two, you get a figure called production costs. So this is 450.
6.
And this is 7.
730.
That. Then from there, you bring administrative overheads. Admin overheads. These are now part of non-production costs. Non-production costs. So in finance, it is 250. Lakini ukiangalia kwa information number 3, costs they are recovered at 3 per unit of production. So we go and check the units that were produced. So the units that were produced, they are not mentioned. They are not mentioned, but we can get them easily. There was no opening stock, but we sold 120. Can you see sales? Sales of how many units? Why is statement? 120. Abigail, are you able to see that?
No.
Towards the end of the table, before you get the addition.
Yes.
And the finished goods, the closing stock is how many units?
40 units.
So if we sold 120 to Kabakisha 40, that tells you we produced how many?
160.
160. Yeah. So that would be 3. Maybe I could say 120 plus 40.
480. 480.
480. And then we go to this other one. Admin is 250. Admin is 250. The next one. I will mute you for recording quality. You can hear the background noise.
Okay.
So we will chat via typing. Okay. So that is the admin. The next one is selling overheads. Selling overheads. Selling overheads, according to information 4, it is 4 per unit sold. So it will be 4 times 120. So you can be typing your answers, Abigail. I'll be able to see them. We have 480. But in finance, the selling is also 480. The selling is 480. Then we have bad debts written off. Bad debts. So bad debts in finance, it is 20. But bad debt is an item of finance. It never appears anywhere in cost. So we are not going to recognize it in cost. We only recognize it in finance. The next one is preliminary expenses. Preliminary expenses or costs. These are costs that I incurred in forming a company, in creating a company. And they are only in finance. They are never in cost. They are only in finance. So we go to finance and give them 10. They are only in finance, not in cost. We have legal charges, which are closely related to that. Legal charges, they are also closely related to preliminary. They belong to finance only. That is fine. That is 5. Then for the dividends, those ones we can put them huko chini kwa income. Although even these ones we should also put them under income, either way. Interest received, hata hiyo tutaweka chini. So cost of finished goods, or rather we call it total costs. Let's call them total costs. Kwanza tuachane na hizi zingine. They will come after the profit. They will come after the profit. $14, $16, $14.95. So hii huwa inafungwa hapa. But as I have said, you would also have chosen this one. On hapa kuanzia hizi za this 4. Ungezileta after the gross profit. Still okay. Still okay. Now from there, you bring sales. Sales is 700. So sales is the same in both. 700. Then you say less opening stock. So opening stock everywhere is seen. We don't have. Then production. Production, we now bring these costs. These 14, 16, at least 14.95. Closing stocks. Now, clothing stocks, we have two of them. We have the finished goods, which is 120 here. And even this side, 120. Then the work in progress, you could also have brought it here before this one. You got it cost of completed goods, or you just bring it here. The beauty with cost accounting, management accounting, we are not confined so much on where you should be put what. You are just interested with the final results more. So we are not confined so much where to put it. So the next one, I'm saying work in progress. Work in progress, WIP. So the work in progress is 80. Hata hiyo ni ya kutoa. Na hapa. So based on that now, we have a figure called cost of sales. Cost of sales. For the first one, gonna 1216. 1295. So now bring the gross profits. E700 less 1216, you get minus 516 minus 595. So from there, you bring dividend received. Dividend received. So the dividend received is an income, and it only appears in finance. It only appears in finance. So your 50, where it only appears in finance. The next one is interest received. So interest received, it only appears in finance. 10. It only appears in finance. That's all. Oh, bado hatuko tumeweka hiyo charges eh? Oh, tuweka iko charges tuweka. Okay, so tumeweka kila kitu. So that gives us the net profit. Hii imebaki minus 516 and minus 535. So what was being tested there is the ability to know who belongs where. The ability to know who belongs where. So from there now, you are told to prepare a reconciliation statement. You're told to prepare a reconciliation. This one, you know, when we are doing the reconciliation, we always begin with profit per costing books. Profit per costing books is minus 516. Then adjustments. Adjustments, this one becomes very simple because what you do is simply to go checking the amounts, whether they are different. Naona sasa kama hii ya material is different, hii to 80 na hii to 50. So direct materials costs. Direct materials costs. There is a difference of fat. So we ask ourselves, what did the cost people do? They overstate statements. Yeah. And this being an expense, when you overstate an expense, it makes profit to go down. So to bring it down, you are supposed to add it back. So we now add. That one we are supposed to add. Yule mwingine, you go item by item. Direct materials, direct wages, those zinafanana. More different. So hizi totals you don't take. Kuja kwa overhead. Naona watu wa cost walitumia 76 au wengine wakatumia 380. So factory overheads. Factory overhead costs. The difference ni 4. So what the cost people did when you charge your, when you charge a smaller amount of expenses, cost profits go up. So to bring it down, you're supposed to subtract. You're supposed to subtract. Huyo mwingine ni huyu admin. Naona hii admin is different. So admin overhead costs, administration overheads. Give me the difference. 200 to 30. So here to 30, what they did now to our costs, when charge me, so their profits went down. So to bring it back, you add, because they overcharged. Beginner is selling overheads. You see, me 480. So no problem there. We are beginning bad debts. There's a difference. How one is 0, how one is 20. So get the bad debts. So bad debts, we have 20. Now here 20, watu wa cost hawakucharge. So we need to charge. We need to charge, so we subtract because it's an expense. The same thing with preliminary costs. Preliminary costs. The same thing, that is minus 10. And the same thing to do with legal charges. Legal charges. hata hiyo ni ya charge -5. Haya, sales zinafanana, opening stock zinafanana. Hii production cost hata kama hazifanani, we will not get the difference because remember hizi ni total size, so they are already included. Hii finished goods closing stock zinafanana, huko hakuna shida. So mahali kwingine tuko na tofauti ni hapa kwa dividends received. So dividends received, so that is an income of 50. So what were costs, they never included it. So it is time to include it. And because it's an income, we are supposed to add back. And the same argument is for interest received. Interest received is positive 10. So with that now, if everything is done well, if everything has been done well, you should be able to get profits per finance books, which was -535. Check whether it agrees. Iko sawa, eh? So tumesema imekubali. Abigail, are you okay? Abigail? Abigail, unmute if you're not able to type. I hope the background noise is no more. There's something like that. I was asking whether you are okay.
Yeah, but I'm getting 497. No one.
You're getting
497.
yours is not inside.
Yeah.
Minus 516 plus 30 minus 04 plus 230. Wewe unaadi vibaya kwa sawa kabisa.
Okay.
Kwa sawa. I hope you have written the values for it.
Yeah, I have.
Then iko sawa kabisa. Riyad again. Are they okay now?
Yeah.
Okay, good. So the next is May 2017 1. May 2017 question 1. That is the next focus. As you can see, the following information relates to the output levels and corresponding mobile cost for Fox Limited for the last 4 months. So we are taught to use the HIRO method. So HIRO method. HIRO method. So using the HIRO method, you are supposed to take A plus B X being equal to R. That is how you write the equation. Then you go to the units or the hours, whatever is the case, you pick the highest. The highest, as you can clearly see, is 100. So you will say it is A plus 100B, and the cost is 17,500, and this is the high or the highest. Then the lowest is 50. So A plus 50B, the cost is 10,000. And this is rho. That is rho. So you subtract these two equations. You subtract these two equations so that you are left with 50B being equal to 7,500. And based on that, tell me B is shillings what? Shillings 150. Then you proceed and say A plus 100 times 150 is 17,500. So A must be shillings what? 2,500. So thus, Y is 2,500 plus 150x. Remember, this equation is in thousands. The figures we have used, they were in thousands. So when x is 120,000 units, 120,000 units, y will be 2,500 plus 150 times 120. This is the catch. Most people will put 120,000. But remember, the equation is in what? It's in thousands. So you have 20,500. I still want to use the question to remind you of something else that is called least squares. Least squares method, or the simple regression. So this one, we say y is equal to a plus bx, where b is equal to n sum of xy minus sum of x sum of y. You divide this by n sum of x squared minus sum of x. You square this. Then a is sum of y minus b sum of x. You divide by n. So from there now, you proceed and prepare a table that has 4 columns. This is x, where you have 100, 75, 95, and 50. So if you add those, the same 100 plus 75 plus 95 plus 50, you come at 320. 320. Then y is 17,500. 17,500, 12,500, 18,100, 10,000. Say 17,500 plus 12,500 plus 18,100 plus 10,000. 58,100. 58,100. You require also to get a column where x and y are multiplied. So this is 100 times 17,500 you get 1,750,000. 75 times 12,500 is
93,700.
9,700. 95 times 18,100 is 1,719,500. And then this is 500,000. 500,000. So plus 500,000 plus 9,700 plus 17,50,000. You're getting 4,907,000. Require a column of x squared. So 100 square is 10,000. 75 square is 56, 25. 95 is 90, 25. 50 square is 2500. So plus 90, 25 plus 56, 25 plus 10,000 is 27,150. So that means that B is these are 4. 4 times 4,907,000 minus sum of x, which is 320, times sum of y, which is 58,100. You divide here by 4 times sum of x squared, 27,150 minus 320 times 320. Check whether you get 167.1. 167.1. Okay, then A will be sum of y, which is 58,100 minus 167.1 times sum of x, which is 320. You divide all this by 4. Divide all this. By multiply by 320. 58,100 minus the answer. You're getting something close to 1157.3. Somewhere there. Okay. So that's y is 1157.3 plus 167.1x. Once again, remember the equation is in thousands. The equation is in thousands. So when x is 120,000 units. Y will be 1157.3 plus 167.1 times 120. So 1157.3 plus 167.1 times 120 is shillings 21,209.3. So what you can see is that the different methods do not give the same answer. And in 20, then we get 21. That's why you find different companies selling the same product for different prices, because they all depend on how you forecasted the cost. Good. Abigail, are you okay?
Yes.
Okay, so correct. Okay. Part B of the question. Part B of the question.
Excuse me.
Yes.
Yeah, I was asking if, for instance, you're given X in linear, I mean, as in the least square method, you're given X in units and the Y in shillings. Are you supposed to change it?
No, you don't change. You don't change. They don't need to be the same format, as in the same units of measurement. At easy as shillings, shillings. No.
Okay.
Units, no. If these are units, these are costs. And that's why we call them cost forecasting method. So we are using units to forecast cost. That's why,
and they can change.
Though these ones were units, the end result there is what? Cost.
And they can, Y can also be given as overheads, right?
Yes.
Okay.
So many things can be given as so many things. What is important is to know who is your X and who is your Y. And X is the one that makes the other one to change.
Okay. Yeah.
You can find it in very many ways. Very many ways. Okay. So we have part B of the question, which is a cash budget question. And we are told to do the cash budget for 3 months. So part B of that question is the cash budget. And this one for the month ending September. So we have September. design, you will fill in as you need. So this is August. This must be July. Then we have details here. So this is the cash balance. Cash balance. So as I told you the other day, we always begin by bringing the items of receipts here. The receipts. So we look at the question and get to know where money is coming in from. You can see tax on manufactured single product, branded PS. The management accountant is in the process of preparing the budget for that quarter. We have sales there, production, variable costs there, selling price, monthly fixed cost, labor, suppliers, the variable overheads, 50% of sales on cash. The opening balance is that a machine bought. Yeah. So from what you can see there, money is coming from sales, and these sales we have cash. We have cash, and this cash, according to information 8, we are told it is 50%, and then we have credit, which we are further told is also 50%. There is nowhere else we are getting money from. So if nowhere else, then pia hapa tunasema sasa hii nayo inaitwa total receipts. Total receipts, which we designate as A. Total receipts, which we designate as A. Then we now bring the payment here. The payments. And the items that are taking money away, we have the variable cost, which is direct materials. Direct materials. We have direct labor. Direct labor. And we have variable overheads. Variable overheads. Then according to information 4, we have fixed costs. We have fixed costs. Information 5 is labor costs, which already we have mentioned. 6 is suppliers, that is materials. Variable overheads, tushaweka. Then information 10 is talking of machine. You will buy a machine. So that is all that we have there. So that being the case, It then means we have something called total payments. Total payments, which we shall designate as B. We shall designate that as B. Then from there, I told you we got the third part, which is called balances. And balances, we have surplus or deficit, and deficit should be brackets. And this is supposed to be A minus B, you call it C. A minus B, call it C. Then you are supposed to bring the opening balance. The opening balance, which we call B. And like the other question that we had the other day, here in our draft, lakini kama kulikuwa na overdraft sasa ingekuja hapa na ingekuwa imeapia hapa after the machine. Yeah. So now this one does not have. So straight on, we get to the closing balance. And the closing balance will then be C plus D. What is the design? So sasa tuanze kusoma and we record the lines. So we can have our figures without. I can also take that advantage to invite you. Haiko inaulizwa lakini inahitajika. Invite you how to draw sales budgets. Sales budget. So sales budget, what details? We have units, we have the price, and then revenue or the amount. So as you can see, in the month of July, it is the first month of July. Units are 1,500. And the selling price is 8,000. So if you are to say 8,000 times 1,500, it is 12 million. 12 million. You come to August. August, we sold 1,800 at a price of 8,000. So 8,000 times 1,800 is 14,400,000. And then you come to September. September, we sold 2,000 at 8,000. This is 16 million. 16 million. That is how you grow a sales budget, in case you come across it. So that now helps us to get tunaambiwa according to information what? According to information 8, 50 is cash and the balance is paid the foreign money. So he 12 million tunalipwa 6,000 that month because our figures are in thousands. Alafu sasa hapa August tutalipwa ile ingine imebaki 6,000. Then ile ingine kwa August 7,200. So tulipwe 7,200. Hiyo ingine tutalipwa huko September. Na hii ya September 8,000 tulipwe hapa. So hapa hakuna kitu tunalipwa because we are not told May walikuwa wameuza ngapi. We are not told May walikuwa wameuza ngapi. So that means here we should be talking of 6,000, 13,200, 15,200. So this question is very good because it has some other workings. The other working that we want to have is called production budget. It's called production budget. Production budget. Now, production budget, as you know, we always have details. And we start with what? Sales or expected sales. Expected sales. You add what? Closing stock, you less the opening stock, and this will give you production units. That will give you production units. That is the format of a production budget. So tukikuja July, we expect to sell 1,500. What does the question say about closing stocks? So it has not mentioned to us. But we know production was 1,700. So if production was 1,700, I told you when you are dealing with the stock budget, and they have not mentioned about the stocks. They have not mentioned about the stocks. If production is more than sales, the balance is the closing stock. The balance is the closing stock. But if sales are more, say we use 3,000, but you produce 2,000. The balance is the opening stock because you cannot sell more than what you produced. So if we produced 1,700 na tukauza 1,500, hiyo ni kumaanisha we must have closed with what? 200, and we did not have what? Okay. That's the meaning. Hope you have gotten that. That if production is more than sales, the difference is closing stock. But if production is less than sales, the difference is opening. So we now go to August. Sasa hii August, we are selling 1,800. We do not know the closing stock, but we know the opening must have been 200. This one. The closing here becomes the opening here. And we are told they produced how many? Production was 1,900. So this must have been 300. So the closing stock is 300. September, we also argue the same way. We sold 2,000. The opening is at 300. And then the production was 1,900. So this must have been a closing of what? 200. Yeah, so that's 2,000 plus 200 minus 300 gives us 19. So this question you could still have solved without the production budget, because all what we need to come here are these units. But I wanted you to remember how to make that. The next budget that you require so that it takes you there, is the production costs budget. Production cost budgets. Production cost budgets. So the production cost budgets, we're just taking the variable costs. Let's specify here we are looking for the variable ones, because the fixed is already given. So we have the details. The first one is direct materials. Then I have direct labor. Then I have variable overheads. So here production costs budget. It is not anything new, but it's exactly what you have been hearing when we have been saying direct materials cost budget, direct labor cost budget. It's only that now sasa yeah. So tukikuja August, July. Start with July. It will be dealt with like this. Utachukua these units that were produced 1,700, multiply by the material costs. Direct material costs is 1,500. 1,500. So 1,700 times 1,500, I'm getting 2,550,000. Direct labor, I will also say 1,700 times, each is 1,000. So I get 1,700,000. Then 1,700 times 500. So 1,700 times 500 is 850,000. 850,000. So I go to August, where I produced 1,900, each costing 1,500. So 1,900 times 1,500 is 2,850,000. 1,900 each costing me 1,000. That is 1,900,000. 1,900 each costing me 500. That is 950,000. Then I come to September. September, it is also 1,900. Each costing 1,500. So it is 2,850. 1,900 us at 1,000. So that is 1.9 million. 1,900 at 500. That is 950,000. Abigail, are we together?
Yes.
Good. Now, so tulikuja kulipa materials according to information 5. We are told suppliers give 1 month credit. Hiyo ni kumaanisha ukinunua this month unalipa the following month. So hizi materials zenye tununua July au tulikaa July ndio tutakuja kulipa August. So hapa July hakuna kitu tunalipa, lakini August tunalipa 25.50. Na August rather September tunalipa hii ya August 28.50. Because tumepewa deni ya 1 month. Labor tunaambiwa by information fund. Those ones you pay as we incur. So every month tunalipia. So labor tunalipa 1700 here. Hapa tunalipa 1900. Na hapa the same thing 1900. Then from there, the variable overheads, according to information 7, they are paid for in the month following production. So after hiyo tunalipa the following month. So hii 850 takuja kulipa hapa, alafu 950 tutalipa hapa. Fixed costs, as mentioned by information 4, payable 1 month in arrears. So, because this business is continuing, the business is continuing, we have to pay for May or rather for June, because tunajua tunalipa in arrears. Na fixed month, fixed cost keep on, they made the same. So sasa hiyo tutakuja tuweke 1600 hapa, 1600 and 1600, because it's a continuing business, it's not a new business. Machine, according to information 10, tunailipia July 5,000. July 5,000. So sasa ukichukua calculator utasema 1700 plus 1600 plus 5,000 means 8,000. If you subtract huko 6,000 minus the answer, you will record a deficit of 2,300. Na kipa tumeambiwa opening is what? Opening balance is 5,000. So hiyo unaileta hapa. So when you add 5,000, you close with 2,700. Wende kwa yule mwingine tuseme 2550 plus 1900 plus 850 plus 1600 is 6,900. So ukisema 13,200 minus the answer, you get a surplus of that amount. And the opening balance is 2,700. So you add 27, that becomes 9,000. Be September 7, 2850 plus 1,900 plus 950 plus 1,600, 7,300. The opening is 9,000. So ukiongeza 9,000 you work with 16,300. Hii ni total payments, eh? in 900. So in 900. Thank you for that correction. Still have some few minutes. The next question that I want to do is look at this one of November 2017, question 2B. November 2017, question 2B. Look at that. Okay, sorry. So the question may take a while at 10:30. Not a mass, but it can exceed. Will you be okay? Finish at kidogo brother? Okay, Abigail,
Yes,
will you be okay if you at kidogo past 10:30?
it's okay.
Okay. Ili tukiweza kumaliza before that, we're good. So sasa hiyo ingine tulijibu juzi ilikuwa just confined to some specifics. Lakini hii you are told to do the relevant. So when you are told to do the relevant, you do all of them. Do all of them. So I want to divide my board into divide into 3. So as you can see, the first one is towards data control account. So let's draw that account. I think I had said it is which question, eh? I had said it is November 2017, question 2. So we draw stores, ledger, control, account. Now this one, you can give it like 5 to 7 lines. 5 to 7 lines. And we are told the opening balance is 53,375. So the balance brought down is 53,375. The next one is work in progress control account. Work in progress control accounts. Given this one, and give it 6 to 7 lines. The balance brought down is also a debit balance of 104,595. 104,595. The finished goods account, it's not a big one, it's like a small one. Finished goods account. This one should not take more than 4 lines. Finished goods account. The balance brought down is 30,780. Next one is cost ledger control accounts. Cost ledger control accounts. So this one, it is the finance. This one you can give it like 10 lines. It is the one that we normally call financial, and also call it the financial. It's the one that represents the bank. So this one, like work on a credit balance. So balance brought down is 188,750. 188,750. So the first thing at that juncture is to check whether the trial balance is balanced. So add these debit balances, check whether they are equal to this one. You add the debit balances, check whether they agree with this one. Are they equal? Okay. Abigail, they are okay.
Yeah.
Good. So if they were not okay, you would have opened, let's open, costing P&L. Abigail, I hope you remember a similar discussion on this.
Yeah.
Costing profit and loss accounts. So this one you can give it like 5 to 6 lines that way. So kama hazike balance, the balancing figure inaileta kwa costing P&L. Yeah. But now that it's balance, that's okay. So we proceed now. We are told for the transactions during the year, materials purchased 26,700. I told you when you buy materials, you debit the stores and credit the finance or the cost later. So let's start with the stores. Because of the cost later, we can just call it costs. It is an amount of 26,700. 26,700. Then because of the stocks, if we have value credit, it is to show that we have bought 26,700. 26,700. Materials issued to production 40,000. I told you if you're a production, that is direct materials that are taken to the work in progress. So you will debit work in progress and credit the stores. So to answer the store, the material hapo, we credit because of work in progress 40,000. 40,000. And then you debit the work in progress because of the stores. 40,000. Materials issued for factory repairs. So materials issued for factory repairs, those are production overheads. So let's open an account and call it production overheads account. Let's open an account and call it production overheads account. We also have 5 to 7 lines. So when we issue those materials, we debit the overheads and credit the stores. So let's start with the stores. Because of the overheads, the amount is 900. Then you come to the overheads because of the stores. The amount is 900. Huyo mwingine factory wages paid, including direct wages. So let's open an account called wages. Let's open an account called wages. So wages account. Wages account. Not a very big one. 4 to 6 lines. So when you pay wages, you debit wages account and credit the cost rate. So the wages that were paid, they are 77,500. So let's start here with the cost rate. Because of the wages, 77,500. Then we go to the wages we debited. Because of the cost rate, 77,500. 77,500. Next, or till there, we are told including indirect wages. Remember, wages are divided into two. There is the direct and the indirect. So the direct goes to the work in progress, and the indirect goes to overheads. The direct goes to work in progress, the indirect goes to overheads. So the indirect, which is supposed to go to overheads, is 23,000. So that tells you the direct here must be what? 40? No. 54. 500. So we come and record those ones appropriately. So to answer happen a work in progress because of wages. 54,500. 20 for overheads because of wages. We have 23,000. 23,000. Mwingine ni nani? Production overheads in car. I've been telling you when you see the word in car is the other word for paid. So when you pay overheads, you debit overheads account and credit the cost rate. So let's start with the overheads. Because of the costs rate, we paid 95,200. 95,200. Then kidia kwa cost ledger to show that you have paid overheads. You have paid overheads of 95,200. 5,200. Yeah. Production overheads are absorbed and written off. When we are told there was under absorption, rather under absorption is supposed to be a loss. So you debit P&L, credit the overheads. And you only come to realize there is another ukikuja kufunga account. So hiyo unaweka hapa chini. So because of P&L, 3,200. Then ukibia kwa P&L, because of overheads, you bring 3,200. That's how we record an under absorption. Production, rather sales now. So when you make sales, first of all, we need to open sales account. Open like a small sales account. Sales account. That's a small one, not more than 3 lines. So when you make sales, you debit the cost ledger, which is your bank, and credit the sales. So tukianza na cost ledger hapa, because of sales, we will debit to show that we have received the money, 256,000. 256,000. Then you go to the sales account, you credit it because of the cost ledger, 256,000. Then the company's gross profit is 25% on factory costs. Hiyo kwanza tuachane nayo. At the end of the year, work in progress increased by 75. So sasa tutakuja hapa. Because it is at the end of the year, the balance carried down. And that balance carried down, unastahili kuchukua hii opening uongezee 7,500. So this plus 7,500 you're getting 112,095. So we are through with what was given. What was given. So, so for the sales account, that one you obviously close it to the P&L. So tutakuja hapa kuseme because of P&L 256,000. Na hii account itakuwa imefungwa kabisa. Then we go to P&L. We credit it because of sales. 256,000. 256,000. The next one is this one. Wages is already closed. You have a balance figure. Hii tushafunga already. Kuja kwa huyu. This one tushaambiwa the balance, the closing balance. But hatujaangalia the balancing figure. So let's check the balancing figure. And that balancing figure is what must have been absorbed and taken to work in progress. So tutasema 900 plus 23,000 plus 95,200 minus that 200. You have 115,900. That's all. So sasa kwanza ufunge hii account. Hii imefungwa namna hiyo. Alafu ukibia hapa kwa work in progress, you register that because of overheads 115,900. 115,900. So because here now tulikuwa tushaambiwa the balance carried down. What now we need is what was the balancing figure. Sasa tuangalie hiyo balancing figure. Your balancing figure, tuangalie iko size gani. It will be 104,595 plus 94,500 plus 115,900 minus 112,095. 202,900. So that 202,900 is on this side. 202,900. And this must be what was completed and taken to the finished goods. What was completed and taken to the finished goods. So hiyo tufunge na tukimbie hapa tulete hapa kwa work in progress kwa finished goods. Because of work in progress, tulete 202,900. Now, we have a balancing figure, but there is some information that we needed to have seen, to have used. Unaona hiyo number 1 inasema the gross profit is 25% of factory costs. The gross profit is 25% on factory costs. So we need the working. Need the working. So this working will be like this. We have been given a markup because we are told it is on factory cost. 25%. 25%. So this is 25 out of 100. And remember how to convert. We need margin. How to convert to margin. So this will be 25 out of 100 plus 25. So that will be 25 out of 125. So profits, we are looking for the cost of sales. So we are looking for cost of sales. So profit should be equal to margin times sales. Margin times sales. So this will be 25 out of 125 times 256,000. 256 times 25 divided by 125. We're getting 51,200. 51,200. So the cost of sales should then be sales minus profits. The cost of sales should then be sales minus profits. So sasa hii itakuwa 256,000 minus 51,200. You get how much? 204,800. 204,800. So down there, open an account called cost of sales. Open an account called cost of sales. So we are open it here. No space. So open an account called cost of sales account. Just a small one, just one line. Cost of sales account. So what you do, this amount here is debited in the cost of sales and credited in fixed. So let's start from that account. Because of finished, this is what came from the finished goods account, 204,800. 204,800. So ukibia hapa kwa finished goods, because of cost of sales, we had 204,800. Lakini kama hatungekuwa tumeambiwa hii maneno ya 25%, tungechukulia that they sold everything. Sasa hii yote ndio tungepeleka kwa cost of sales. But already now the question they mentioned to us that tulikuwa na hii 25%. So with that done, let's now get the balance carried down. The balance carried down so that hii account kwetu tumeifunga kabisa. Balance carried down. $28,880. Now turudi kwa huyu cost of sales. Tufunge apelekwe kwa P&L. So to the P&L 204,800. 204,800. Na hii tukue tumefunga kabisa hivyo. So kibia kwa P&L, you debit it because of cost of sales 204,800. Haya. Kuje P&L ndio inakuwa ya mwisho together with this one. So tukuje sasa kwa hii stores ledger imebaki. So stores ledger, let's get the balancing figure. 53,375 plus 26,700 minus 4,900. So the balance carried down is 39,175. 39,175. So sasa tuende tufunge hawa wengine. So this P&L, so the profit, this will be profit on this side there. So this will be profit. And this profit, this one is not the same as this, but it was profit. Now you need profit. So Shanghai Panini at 51. So it is 256,000 minus 200 minus 204,800. You get 40,000. Okay. So tukibia sasa huko tufunge yule mwingine. Tutasema 188,750 plus 26,700. plus 77,500 plus 95,200 minus 256,000 is 132,150. So this is the balance carried down. We okay? Abigail, are you okay now? Are you okay, Abigail?
Yes, I am.
Good. So the last thing that you could be, or you need to know, but really you'll be asked to prepare in this paper, but you need to know because you're going to be at the answer. Is what we call the trial balance. It's what we call the trial balance. Trial balance. For the trial balance, we have details. We have debits and credits. So you just go checking the accounts that have the balances. Ya kwanza ni stores ledger. Stores ledger. So stores ledger, it has a debit balance 39,175. Work in progress. Work in progress. It has also a debit balance of 112,095. Finished goods, it also has a debit balance of 28,880. Huyo mwingine ni P&L, kwa tunaweka profit kwanza, profit and loss. Now, profit and loss, it has a credit balance because it's a profit, 48,000. And then cost ledger or the finance ledger. Remember, this one has two names. You can call it cost ledger. You can also call it finance ledger. That is a credit balance of 132,150. So let's check whether they agree. One. 180, 150, 180, 150. So hiyo knowledge tunakumbuka ndio tulitumia hapa check whether it was balanced. Yeah? Now, two things that we need to note about the trial balance. One is that this P&L, or maybe three things. These three will always be debit because of the assets. This cost ledger or finance ledger will always be credit because it is the opposite of the first thing. The second thing is this P&L can either be debit kama ni loss tumetengeneza ama credit kama ni profit. So si lazima hivi itakuwa hapa, inaweza kuwa depending on whether you made loss or profit. The third thing is si lazima uonyeshe P&L, unaweza iweka ndani ya. Remember, I told you when it does not balance, the balancing figure lazima iwe. So sasa hii badala ya kuiweka hii, badala ya kuandika profit, ningekuja hapa na niandike the cost later. Ndio hii 48 hapa. Sasa hii 48 kama ingekuja hapa, you see now this one would have been exactly 180. So that is all. And if you don't have any question, end the lesson at that point. I intend to teach you for 3 more lessons. 3 more lessons. If we do the 3 more lessons, we have covered what was initially intended. Because there are 3 weeks, each 2 lessons. And those 3 lessons, I want to suggest that we have them on Monday, Tuesday, Wednesday. And I think I prefer this hour of 8:30. Is that okay? Abigail, unapata hiyo maneno?
Yeah.
Yeah. So next
Monday.
week, Monday, Tuesday, Wednesday, we meet 8:30 to 10:30.
Okay.
Thank you so much. See you then. I'm sending these videos to you people. Make sure you are able to replay them. Ama kuna kitu hujaelewa.